Now, as we turn to the consumer, I think it's important to highlight, something that we've been talking about for quite a while. And it's that when you look at savings, or excess savings is a better way to describe it, our view is that everybody, we had been saying 90% and lower, or realistically the top 10% still have money in the bank. It's that the lower pieces, and here you can see household income 0 to 40%, 40 to 80% are negative. And the problem is once you go negative and you don't have the pressure being reduced in the market, which when you look at inflation month on month, when you look at credit card debt month on month and rates going up and that piling up, it accelerates to the downside. It doesn't just kind of meander, but you see this pivot point. And our view was that the impacts had been felt sooner. And here's, I think, a great chart, and it's finally something in terms of the calculation that's come out, that 0 to 40% turned negative in Q2 of 2022. But the biggest tranche of spending, in our view, has been that 40 to 90%. And our problem with that is that we saw them going negative already. They had them going negative in about realistically Q2 of this year. We think it was probably a little bit sooner. But again, it's hard to say. And for those that have been following us, we've said that top 10% it still has money in savings. Our view is that it's going to stay there. There's no impetus for them, given where things are in the market, to take that out and either spend it or really invest it. There's a certain amount of, let's just park this money, put it in a money market account, put it in some treasuries. And that's where we're seeing some of these pieces. So Americans outside the wealthiest 20% of the country have run out of extra savings and have less cash on hand than they did when the pandemic began, according to the latest study of the household finances by the Federal Reserve. And again, that's exactly the case. They are worse off. Now, all of that Biden money, the money that was dumped in, is now gone. But an interesting thing, so the morning's comprehensive update from the National Economic Accounts shows that savings rates was lower than previously thought over the past decade. And that's an interesting point because, again, a lot of these are calculated numbers. And I am by no means saying, see, they're lying. It's like, it's a hard number to calculate. All of these things are very complex. You're using some stagnants or some baseline, and sometimes it's wrong and you have to adjust it. So it's not like this is criminal. It's just you have to respect the data. And that's why we look at so many different pieces, so many different inputs, because you're looking to try to find the data telling a story. But you have to respect the fact that sometimes that story can be skewed too bearish or skewed too bullish. And it's a matter of, righting that ship. Just like with this, you might say, Mark, you're so bearish. I am not here saying that we have a hard landing. I'm saying that flat out, I do not think we have a hard landing. But I do think we go into a recession. It's just going to be the prolonged one. And that's where I differ. It's the length of time. I think, the fact that people say we're going to have no landing, that I find quite absurd. But again, I do think we're getting to this point and this maximum pain point with the consumer spending update. 39,000 Americans filed for bankruptcy in August. Credit card debt for the first time ever passed $1 trillion. Student debt repayments have officially resumed. And when you look at that total outstanding credit card balances, and then you look at where credit card rates are, that's why this compounds, because the credit card balances are going to keep going up because the interest, which is for some or for many over 20%, compounds rapidly. And so 1,000 becomes 2,000, becomes 8,000 very quickly under that regime and under that increase in pressure. Now, this is interesting because when you look at GDP US personal consumption for Q2, you can see that the final adjustment took growth rates from 1.7% to 0.8%, and the weakest since the pandemic declined. And that's what we've been saying is that, not that it was wrong that growth, that the consumer was active in Q2. We said they were active in Q2. It's just the trend. And our view is that the trend continued to the downside. As you can see, kind of obviously Q1 had that nice spike, but the trend has been to the downside. And our view is that Q3 we thought it was going to be negative. Maybe it's not negative yet, but it's 0.1, 0.2. But that leads us into that Q4 where you see that pivot point to the negative front, which is going to be that problematic piece as we head into 2024 and why we do see that recession hitting here. Now, again, kind of tying this back to where we are. So the Taylor rule estimate, as you can see, is still slightly above where the Fed funds is. We've done some of our own kind of R-square adjustments, which puts us at about 6.25%. This probably is at about 6%. It just gives you an idea that, again, at the same time, it shows you why the Fed, for some reason, stayed so low for so long. And I'm not saying that they should have gunned it in 21, but there was no need to continue to see that rate piece, and why we should have seen those rate increases faster to kind of get in front of what the inflation was going to look like. And again, stopping the MBS purchases. Well, one, never doing mortgage-backed security purchases. But even if you can't take you can't take it back once you started it. But we've been saying since 21, there was no reason to continue that past January of 21, February of 21, and instead they continued it throughout until 22. Conference Board US leading index continues to be negative, slightly better than estimates. Expect to be at negative 0.5, came at negative 0.4. Again, just very consistent with what we've seen. Then when we look at US financial conditions, again, it's tighter, but it's pulled back a bit. Consumer spending appears to be slowing after that strong back-to-school shopping. So when you look at the brick-and-mortar credit card spending, you're starting to see that roll over the first 3 weeks of September. And that's that break, because you had that nice little bump in July into August. But then you saw that kind of rollover. And that's where we see this pressure as we continue as people pull back, given the pressure points, given the problems that we've seen following some of these underlying pricing. Now, looking at some of the leading economic indicators in general, when we start looking at the global manufacturing, expected to be at 48.2, came in at 48.9. New orders, 48.5. Again, just kind of bumping along in a contractionary standpoint, but not dire, but still contracting. And 48.5 in new orders, you're firmly in contraction, because there's that margin of error. If it was 49, 49 and a half, you're like, all right, well, it's probably flattish. This is, it's problematic. And that's where it continues to show that, again, softening. But then the max pain that we're seeing is the input prices. Input prices are accelerating to the upside. And if you look at it, manufacturing input prices are back into expansion. So we had a short period of deflation in manufacturing pricing, and now it's back up. Diesel prices are showing you where it's going. Those problem sides, Chicago's Fed survey of business conditions, hiring expectations the next 6 months continues to get worse, which isn't surprising given that you've seen some of that reduction in spending, which is why people are assuming incomes are going to slow and why we see additional pullback. U.S. service PMI, we expected to be at 50.7, came in at 50.2. And this is what we've been talking about, that slowdown. Slight expansion. Again, margin of error is at 50.2, 49.8. Again, we're in that margin of error, but the incoming new business for services is 47.5. That is firmly in contraction and a key leading indicator, which is why we do see that services, slipping into the negative territory as we head into Q4. Dallas Manufacturing Index expected at negative 14, came in at negative 18.1. New orders, negative 5.2, but the new orders not as bad as they were. But again, that balancing act looking at still being in contraction. Dallas Fed Manufacturing Outlook prices paid, though, re-accelerated to the upside. It never quite went negative, but now you're back above where we were in 2022. Moving in the wrong direction. And then when you look at Case-Shiller, another, now we're back to positive. And this is a lag, so you still have some of that negative drawdown in terms of pricing that's going to help keep inflation capped. But this turn back up is, on both, because it's not just Dallas that saw this reinvigoration of pricing, but between prices and housing, that's a problem for the Fed. And that's why we don't see this, they're going to cut in Q1, Q2 of next year. It's, again, one more rate hike to try to get in front of these two things and then keeping that for an extended period of time. Then when you look at the Richmond side, the Richmond Fed looks to be turning higher, and headline blue has jumped back into expansion, and employment is showing some strength. When we look at the numbers in general, new orders back to 3, capacity utilization back to 6. So it's important because it's also time frames. So we saw some negative with Dallas, Philly, New York, and Philly. But now here you're seeing a bit more in Richmond. So it's just that balancing act. The trend is still intact on the negative side. It's just not going to be as dire where you're going to get this massive depression. It's just, again, this problem in terms of these levels. Philly Fed non-manufacturing index, negative 16.6. 6-month company outlook is coming to the lowest it's been since the COVID downturn. And that's, again, showing some of these things, kind of offsetting some of these problematic pieces, which we continue to highlight. Non-manufacturing unfilled orders in the Philly Fed was negative 8.2. Kansas City came in at negative 8 versus the estimate of negative 2. New order shipments and production all sank. Prices paid eased lower. And so again, it's when you look at it, Richmond was good. You had some bright spots, but the trend is still down. The trend is still showing a recessionary progression as we head from Q3 into Q4. Adjusted core capital good orders came in at positive 0.9 versus the estimate of 0.1. The estimate was the core shipments was 0.7 versus the estimate of 0. And again, it's just that balancing act. It's not that you're going to see this dire piece, but it's just you have to weight it. So August durable good orders came in at positive 0.2 versus the estimate of negative 0.5. Good capital good orders, non-defense, ex-aircraft expected to be at 0.1, came in at 0.9. So again, you saw two periods of slow, one period of a little bit higher, and that's that weighting that we continue to see in that balancing act. Now, capital good orders, real capital good orders is still moving in a downward trend, but nothing dies in a straight line. You kind of have this ebb and flow, and same thing. So you had a nice little bounce, but you're still firmly in that downward trend. Then you look at Conference Board Consumer Confidence, expected at 106.2, came at 103. Conference Board Consumer Expectations moving lower. So again, you're still in this very uncertain time with some pieces showing, look, this was a good month. You've had several bad months. You had a good month. The problem is that good month a trend pivot? Are we seeing that movement? But nothing else is confirming. You're getting some one-offs, but as you should, because people in Richmond, people might have needed more goods. They might have needed more inventory, so they put in more orders. There's more activity, but it's more of a regional piece and less of how it's looking across the U.S. Conference Board income differential 1.9, Conference Board labor differential, again, all moving in that negative trend, and the income differential expecting higher versus lower wages, showing you more and more people are expecting lower wages, not higher. When you look at the FOMC, Dallas Fed Service Activity Index declined to negative 0.86, 8.6 last month. Nearly every sub-index was lower month on month, but prices paid, big bounce. So again, this is that stagflation that we continue to see as we head into next year. This is just looking at Chicago. Chicago came in at negative 0.16. And all of that, again, showing those pieces because it's really not seeing or confirming some of the other things that we've seen. Mortgage rates and home sales, 30-year fixed rate mortgages continues to move higher. Right now we're getting close to about 7.2%, and home sales typically track that. Falling home builder confidence typically leads the construction permits as you have that bifurcation. But again, you're starting to see some of these pieces. We've started to see more homes fall through. You're starting to see some reduction in prices, but it's very slow. Home purchases are falling through at the highest rate in almost a year, 15.7%. Nationwide, nearly 60,000 home purchase agreements were canceled in August, which equaled 15.7% of homes that went under contract, highest share since October of 22. Home builder sentiment fell to 45 versus estimate of 49. Current single-family sales, future single-family sales, and prospective buyer traffic components all fell. There's a certain amount of seasonality within that, but there's also the fact that there's still limited supply and very high prices given, and then, layered on the fact that interest rates are still elevated and we don't see that changing. Summer resurgence in home prices confirmed. Core Logic index advanced, bringing the 3-month annualized gain to 9%. Home price index for FHFA increased by 0.8% month. So lag data, but confirms that you had that momentum and it hasn't faded yet, which is why we do see the Fed staying firm. But mortgage rates, what we saw, some home builder sentiment starting to turn. You're starting to see some of those pressure points. August housing starts came in at negative 11.3% versus the estimate of negative 0.9. Building permits came in at positive 6.9 versus the estimate of negative 0.2. So again, that bifurcation, but the U.S. pending home sales index has now fallen by 44% from its peak, which is worse than during the Great Financial Crisis. But you had such an elevated level that, again, you're expected to see some of that. So it's hard to compare apples to apples there, but realistically, we are seeing those pressure points. And this is why when you look at the lack of availability, well, prior to 2020, just 4% of all outstanding mortgages had an interest rate below 3%. Now, 23% of all outstanding mortgages have an interest rate below 3%. Share of borrowers that have an interest rate of 4 to 5% fell from 40% to 20%. Just 9% of all borrowers have an interest rate of 6%. And I can assure you, anybody that buys a home now is going to be adding to that 9% side, which is why that top piece creates those golden handcuffs. New one-family home sale, family home sold continues to fall. We continue to see that moving in a downtrend. But here's an interesting one. So new one-family home month of supply is now the highest it's been since 2016. And this is what we've been talking about. As new volume comes to market on the rental front, on the new home side, that's where we're going to see those prices, where there's going to be more competition, and it's going to become, not right away, it's going to take time, more of a buyer's market. Now, when you look at new U.S. Homes sold, when you look at it, new private owned, completed and sold, under construction, not started, you can still see that skew to under construction and not started. U.S. existing home sales continues to be at the lowest since going back to 2016. Existing home inventories continues to be low, but new home inventory is coming on, and that's where we see that coming through. We're seeing more units, more multi-units trying to, again, kind of take advantage of this. Total multifamily units under construction, as we've been saying, took out the highs from 1974. August pending home sales came in at negative 7.1% versus the estimate of negative 1%. Worst month since September of 22, taking overall level down to lowest since April of 2020. Again, all moving down in that negative trend. No signs of life from mortgage activity. Purchase index change hovering at negative 27%, which is at the lower end. Again, why get a mortgage at this point? Multifamily housing starts are rolling over because we have so many under construction. Why are you going to start a new one? You need to complete this one. And a lot of these companies have added units because it's like, look, I can't build 2 units. It has to be 8. So you're seeing some of that bleed, which is why this makes sense to see some of that reduction coming in. Total multifamily units under construction starting to roll over, but you can see just how much there was. So again, you're starting to see a little bit of softness, which makes sense. So that's what we have for you on the U.S. front. In the next segment, we're going to go deeper into Europe and some of the issues that are happening there.